visual proof of his fame as a central banker, receiving the award for one of the world's best central bankers on November 7th, 2024. So congratulations, Ellie. I knew you could do it. Ellie's appointment to the governorship of the central bank in 2023 is just the capstone of a long and distinguished career. Before joining the central bank, Ellie was involved in fact, I might even say was one of the founders of the Masters in Central Banking program at the Asia School of Business in Kuala Lumpur. He joined the Bank for International Settlements 19 years. He worked for the BIS for 19 years before serving as head of the Financial Markets Group. And before moving to the BIS, he was an economist at the Federal Reserve Bank of New York, which is where I met him about 3 decades ago. Pretty shocking. He's written a number of well-known papers in macro and finance. Maybe his home run paper, arguably, was his paper with Michael Fleming, Price Formation and Liquidity in the US Treasury Market, the response to public information from the Journal of Finance. And it would take me forever to compile a list of all his other really interesting publications. I made an effort to count the number of publications from the BIS quarterly BIS publication, and I lost count. I just can't count that high. Plus a number of the Economic Policy Review. A lot of his work has covered the yield curve, and there's a number of other papers on sovereign risk contagion and sovereign risk spreads. So without further ado, I'm going to turn it over to Governor Remolona to deliver his talk on slow boats and rough waters. Welcome, Ellie.
Thank you, Ken, and congratulations to the CDE for organizing a wonderful conference. I was here, as Ken mentioned, I was here in 2019, the spring term of 2019. I enjoyed myself so much at that time, so I couldn't say no when Ken asked me to come. I didn't really know what I was supposed to do, but I wanted to come, so I came. This is not going to be an academic presentation. I'm not going to do any econometrics, but it's consistent, I think, with the theme of the conference. I plan to look at the issues from the ground in the Philippines. I want to talk about challenges at the central bank that I didn't really know about before I became governor. I thought monetary policy was so easy, but apparently there are challenges. As background, the central bank in the Philippines has more or less independent monetary policy. They have an inflation targeting regime, almost consistent with the Svensson definition of inflation targeting that Roberto talked about. The transmission mechanism is the bank lending channel, and we talked about that since last night. The exchange rate regime is a floating rate, I would say a dirty float, because there's occasional intervention, but no consistent playbook on intervention, I have to admit. The policy rate, or the monetary policy tool, is an overnight policy rate. So let me give you a rough outline of what I'm going to talk about. I want to really focus on the exchange rate as an inflation risk factor. There's a recent literature on inflation at risk. And in that literature, the exchange rate is identified as the single most important risk factor that distinguishes emerging markets from advanced economies. And I want to talk about that. And then I want to say something about the market macro structure, not microstructure, but the system of markets and how they operate together, and which which players are in them. That I think is important because it affects inflation expectations. Which markets drive the narrative and which markets influence inflation expectations. And then I want to end with just what we're trying to do to strengthen the transmission mechanism. Let me start with a picture on, that breaks down the sources, the direct sources of inflation in the Philippines. The brown bars, the brown segments are about energy prices, mainly oil prices. And then green is food, and then blue is core inflation rate, which takes out the volatile parts of inflation. These are just the direct effects. And what happened in the Philippines is oil became a big factor when Russia invaded Ukraine, and Russia cut off the supply of gas, natural gas to Europe, and that affected the price of oil. Price of oil went up. So that led to second-round spillover effects on core inflation. Oil, as you know, is an upstream good. It affects the prices of a lot of downstream goods, and inflation peaked at 8.7% in January 2023. That's well above our target range. Our target range is 2 to 4%. And I think there's a literature that says when you're above 7%, inflation begins to affect growth. So we worried about that. The thing we had a hard time managing was the exchange rate depreciation that accompanied the rise in oil prices. There was a discussion at the BIS on what you should do when there are supply shocks like this. And the textbook or the standard BIS answer is you should look through them, because supply shocks, the prices come down, they go up, and they come down. But in fact, because there are second-round effects on the prices of goods for which prices are sticky downwards, those second-round effects don't come down. The price of oil may come down, but the second-round effects don't come down. And if inflation stays high, it begins to affect inflation expectations. The BIS ideology, I guess, it says that's okay as long as inflation expectations don't get de-anchored, as long as they stay kind of close to your target. We don't really know how to measure the anchoring. There are papers on it, but they're kind of so-so papers. So you look at the tails of the inflation. When you do a survey of inflation expectations, do the tails get fatter? But these are not reliable means of measuring the anchoring or de-anchoring of inflation expectations. The thing that complicates this, I think, is the exchange rate. It's not usually listed as a factor in inflation, but in fact it is. The reason for this is in the Philippines, 90% of goods imports are invoiced in US dollars. So the relevant exchange rate for us is really just the dollar-peso exchange rate. We don't really look at the nominal effective exchange rate. We tried, but it didn't really help us. I think this is the invoicing phenomenon is a good paper for you guys, especially Andres, maybe, who looked at dollarization. You might remember that before Brexit, the imports into the UK were invoiced in euros, mostly euros. And then after Brexit, the invoicing shifted to dollars. So there's something interesting about that phenomenon. In the Philippines, 90% invoiced in dollars, and that makes a difference. our number one source of imports is China. It's not the United States. But China invoices their exports to us in dollars, not renminbi. When we try to estimate the pass-through, the exchange rate pass-through, we use dollar peso, not the nominal effective exchange rate. And we find very clear threshold effects. So the exchange rate doesn't seem to matter when it's an appreciation or it's a small depreciation. But at some point, when depreciation is big enough, then it begins to affect inflation. So it's asymmetric because appreciation of the peso doesn't make a difference, but depreciation does. That gives us a lot of trouble, as I will explain. By the way, I think this is consistent with prospect theory. Kahneman and Tversky told us that in people's minds, losses get weighted more heavily than gains, and then it's important. The things that affect our expectations are things that come to mind, that easily come to mind. So the big events affect our expectations. So here's an episode when exchange rates and oil prices combined to lead to the high inflation rates that we faced in 2022 and early 2023. And there's an episode between Q3 2021 and Q2 2022 when, as oil prices went up, the peso dollar exchange rate also depreciated. The reason for the depreciation was not something about the Philippines. The reason for the depreciation was the geopolitical tensions. It was a strong dollar story. But in terms of our economy, it meant the peso depreciated against the dollar. In fact, many of the episodes of peso depreciation were episodes of a strong dollar rather than a weak peso. And these two, so red here is the exchange rate. It's indexed so that they look, they have the same scale as the oil price, which is blue. And so that episode led to the high inflation rates that we saw in 2022 and early 2023. So we worry about the exchange rate, and we've been trying to formulate a playbook for exchange rate intervention. And the last two papers, I think, will be very helpful for us. Let me say a little bit about the market macrostructure. In the Philippines, as well as other countries in the region, Thailand, Malaysia, the dominant market is the foreign exchange market. So green is the foreign exchange market. This is measured in terms of transactions in the market. And then the next important market is the fixed income market. But even that is not liquid. The stock market is kind of nothing. There is a stock market, but it's a pretend stock market. It doesn't really do very much. And I think that's true for most of the region. So it's the foreign exchange market that basically drives the narrative. People talk about the exchange rate all the time. People don't know what the policy rate is. But the exchange rate, everyone knows what the exchange rate is. So here's an example. I was interviewed on TV, and so the question that was asked was, so Governor, will the peso turn senior? Let me translate that. Senior is a big deal in the Philippines. Senior means you're 65 years old. And it also means you get discounts on everything, on food, on transportation. So everyone eagerly waits to turn 60 years old. At this time, the peso was trading at 57, 58 to the dollar. And so it was close to being senior. And that was a catchy narrative. It was a false narrative, but a catchy one. So we were afraid that it would be realized that the peso would go senior. In the event, it never really happened. But that shows you how easily the narrative in the foreign exchange market can affect inflation expectations. So now let me just list a few things. Our transmission mechanism has been weak, as most of the papers presented here have told us. First of all, we've started to emphasize forward guidance. We used to just announce the policy rate and say that it's because inflation is high or output is low. But now we also say something about the next few meetings, only in a suggestive way, that we don't really say we're gonna. It's just like the Fed. We're not very clear about what we're gonna do next. We've also become more aggressive with our Taylor rule. Basically, we've raised the coefficient on the inflation term, and then we've lowered the smoothing parameter so that, in effect, instead of cutting the policy rate every other meeting, we would cut the policy rate every meeting, something like that. We've reduced the reserve requirement. The reserve requirement in the Philippines was a vestige of the time when our policy tool was money supply. But now it just serves to drive a wedge between deposit rates and lending rates, and I think it weakens the transmission mechanism. We've made efforts to deepen the bond market. I'll talk about that a little bit, but we've also started to think about a good way to intervene in the foreign exchange market. We've been intervening to try to smoothen day-to-day volatility, but if you remember the picture of oil prices and exchange rates, the thing that bothers us is not so much the day-to-day volatility of the exchange rate, it's the swings in the exchange rate. So the exchange rate would swing up, the peso depreciating. That becomes inflationary, and then it comes down. And that's not disinflationary. So it leaves in its wake inflation, and then it's back to where it was. We want to dampen the swings, not really to smoothen the day-to-day volatility, but dampen the swings somehow. And I'm hoping Roberto can help us with that, figure out how we can do that, and maybe Michael as well. So here's our forward guidance. In our last policy meeting, we said the more manageable inflation outlook and the risks to growth call for a shift towards a more accommodative monetary policy stance. So the market takes that to mean we will continue to ease to some degree. They don't know exactly how we will ease, but this says we will be more dovish than before. I think that's it's in a language that we use all the time, so they kind of know what we mean. By the way, in the Philippines, the language of the markets is English. It's not Tagalog. When you're among yourselves, you speak Tagalog, but when you're in the market, you speak English. And sometimes I make comments in Tagalog about monetary policy. It drives the reporters crazy because they don't quite know how to translate. The Bloomberg reporter doesn't know how to translate it into English, for example. But that's part of that's part of the market macro structure. So that's an example of forward guidance. What we also try to do is we stuck in a more aggressive Taylor rule into our model. So this is what the model says. I think it's too good. I think the transmission mechanism won't be that strong, but The old Taylor rule is blue. This is what the model says will happen over the next few years, and the red one is the new, more aggressive Taylor rule going forward. So this hasn't happened. This is just what the model says. I suspect the model doesn't get it quite right, but nonetheless, we're hoping that the transmission mechanism somehow gets stronger going forward with the more aggressive Taylor rule. So in the Taylor rule, the smoothing parameter, how quickly you will move, we've made it smaller, so it's less smooth. And then the inflation coefficient. Inflation for us is the forecasted inflation against the target inflation. So we raised that from 1.5. The original Taylor rule had a 1.5 coefficient. We made it 2.5. I think that might have been too much, but that's where we are. On developing the bond market, we've tried many things, but what seems to work is to reintroduce the interest rate swaps market. We had the interest rate swaps market maybe 10 years ago, but the central bank started to over-regulate all these markets. It's a central bank full of lawyers. There's a minority of economists who the central bank is into compliance number one and then monetary policy number two. So I think we killed the bond market. But a way to develop it, I think, is through the back door. We brought back not the cash market itself, we brought back the interest rate swaps market. That means having a credible overnight rate and then relaxing the regulations on the swaps market. And it did start to come back, so we're very hopeful about that. It's still not as developed as we would like. And then we're thinking about how to manage the exchange rate. We think we would shift to a managed float. Subject to Roberto's comments. I think, Roberto, you said, Michael said a soft float is okay. It preserves monetary autonomy. I don't know what a soft float is, but we'd like to think about it. So I think that's what I have to say. I would welcome questions.
I will be the master of ceremonies again on this. I'm ready to take questions. Anybody up? Would you like to begin, Uzur?
Yeah, thank you. Thank you, Eli. A couple of questions. One is when you switched to more forward guidance, how long did it take for the market participants to appreciate that this is a conditional forecast, a conditional, it's not a commitment?
Not too long. These guys are familiar with the way the Fed does forward guidance, and we try to use similar language, but we always say depending on the data, depending on the evidence.
Because that argument is used by some central banks. Even when I was at the Bank of England long time ago, yeah. Mervyn King was always against forward guidance because, the public will not understand that, even the financial market participants. My second question is, we used to talk a lot about communicating uncertainty about the interest rate path. Now, the latest Bernanke report of the Bank of England forecast says, forget about those fan charts, the
rivers of blood.
Have a scenario, yeah, exactly.
Yeah.
One alternative scenario kind of thing. What are your views on that, Eli?
Well, let me do the earlier question about forward guidance. the bank lending channel, in the bank lending channel in the Philippines, what happens is the banks, every time we make a policy move, they revise their own internal yield curves. They have, but the yield curves across banks are different. So they don't, there's no market in which you can form a consensus on a yield curve. So, but forward guidance does seem to affect these internal yield curves. So it seems to work. Eventually, we want a money market to come back, and then a bond market to, a deeper bond market to develop, so that you have a yield curve the way you have it in most other countries. We find that when Europe, when the EU switched to the single currency in 2000, it left basically fragmented bond markets. There was a German Bund market, there was the French Haute market, there was the Italian market, and they had, the yield curves were different. They were not aligned. They didn't coincide. But a swaps market developed, and that became the benchmark. So there's a market in which you can reconcile different views and form a consensus on what's going on. We're trying to achieve the same thing with this swaps curve. That was a question, or?
Anybody else? Oh, I'll get to you next time. We'll go to Santiago here.
Great. Thank you so much for your presentation. Very insightful. Coming from Latin America, we had a paper, okay, I wasn't alive, but there was a paper in 1976 about Diaz Alejandro about contractionary depreciations. And you seem to discuss this fear about depreciations that might turn inflationary, which I think you didn't mention, but what I wanted to know more was, like, you think this will affect real wages of households that are probably have little access to financial markets, or that they can't smooth their consumption?
We don't seem to have that phenomenon of contractionary
Okay.
depreciations. Our balance, our current account is mostly services.
Mm-hmm.
We have business processing operations. That's a big sector in the Philippine economy. So JP Morgan has people in Manila.
Okay.
They stay awake at night, and
Trading.
they do the accounting for JP Morgan. They do and so on. And then we have healthcare workers around the world. They send dollars home. That's our current account.
Okay.
We don't export too many manufactured goods. We export, in terms of goods, our number one export is semiconductors, but that's part of a value chain that includes Taiwan and China and Malaysia. So it doesn't, there seems to be no export elasticities that to worry about.
Okay. Thank you so much.
You again. Oh, well, first time. Okay.
I also enjoyed the presentation a great deal. I wanted to understand in some more specificity how the interest rate swap market worked. So normally in the US it's fixed for floating of different tenors, and in the Philippines, is it, you mentioned overnight, and is it overnight rates versus whatever the market will bear for the amount of time the market determines it's willing to take?
Yeah, maybe I wasn't so clear. When I say overnight, I mean the same thing that the SOFR rate means, which is, you know, the US version of the short rate is now the secured overnight funding rate. It's not really overnight. It's a short rate. There's a 6-month SOFR, which kind of corresponds to the old LIBOR. So overnight is not really overnight.
But it's a short versus long.
Yes, yes.
So, and And the market is setting the long rates that it's willing to accept for
Yes.
the short rates.
Yes.
And banks want to do this because
It's a very good, yeah, it's a very good way to hedge.
yeah.
It's a cheap way to hedge because you worry only about the interest differential. But it's beginning to help the banks form a consensus about yields at different maturities.
And are banks lending that long at the same time, so they need this hedge?
To be honest, they're lending at maturities that are longer than the maturities in the swaps market. But that's what happened in Europe. So
Right, but that gives them an incentive to extend the market.
yes, and we're looking forward to that. In Europe, the existence of the swaps curve as a benchmark made the other bond markets more consistent with each other. So they kind of converged towards the IRS benchmark, except for a small spread depending on credit risk. So Italy would have a bigger spread than, say, Germany. But it's...
Thank you.
Mr. Sultan, do you still have a question?
Yes. Okay. Thank you very much for your presentation. I have just a brief question. You told us that you changed your Taylor rule, so now it's more aggressive. But when it comes to responding, for instance, if you respond aggressively, then how can you deal with uncertainties? Because in the economy there might be uncertainties, and then if you respond very aggressive, it can also hurt your economy. And yeah, thank you.
That's a good question. In fact, in February, we were among the central banks that decided to pause, and that was because of the uncertainty over external challenges. So we wanted more data, and I think the market understands that.
Thank you, Governor, for the presentation. But I think my question is just an extension of Nu's question about the Taylor rule in terms of specifying the parameters of the Taylor rule. How do you carefully choose so that you don't misspecify, you set it at the correct level, like the beta, the responsiveness of inflation to interest rate? So that was my question. How do you carefully choose that this is our right parameter? We are going to set our beta at 0.5 or 1.5. So that's my question. So what factors do you take into account to come up with that parameter value? Thank you.
That's a very good question. To be honest, we just picked numbers out of the air. We just wanted to be more aggressive. We just wanted to be more aggressive, but of course what you want to do is do maybe a loss function and let that choose the parameters. We haven't had the time to do that, so we haven't actually implemented it. This is just a model telling us what those new parameters would do.
If I might just quickly follow up on that, what is the role of the inflation forecast when you implement your Taylor rule? Is that based on some projection of inflation or current inflation?
Yes. Actually, we're toying with the idea instead of the actual headline inflation number. So we forecast the number 1 year ahead because that's how long the lags are. And then we have the target, 3% target. And then so the difference between those two goes into the Taylor rule.
Any questions or comments? There you go.
Thank you, Governor, for your presentation. I have a question regarding banking regulation. For example, if I know that you worked for the BIS for a while, and you have central bank around the world adopting Basel frameworks. So, does that have any implication for the monetary policy transmission? Does it weaken the transmission, or it's like when we increase the CAR, for example? So what is the implication for that? Thank you.
I think in principle it does. It does something to the transmission mechanism. We follow Basel III quite closely, especially the what's called the capital adequacy ratio, and then there's the liquidity coverage ratio. At the moment, our banks' capital tend to be well above the Basel number, and liquidity is also above that. So I'm still trying to digest the paper. I think it was your paper, Roberto, where you looked at capital and liquidity. Someone's paper looked at the capital and liquidity, how it affects. That's you. Yeah, and then you had the negative coefficient on capital. Yeah. So we will look at that very closely and worry about the Basel ratios.
Well, it looks like you have a question. I could tell. There you go.
Thank you, Mr. Governor. I have one question regarding forward guidance. We introduced in our country forward guidance when communicating the monetary policy. For the very last time, we announced that we'll be decreasing the interest rate for the next 24 months. We had a discussion if 24 months is long time horizon, or we have to reduce it, because this can have some implication in the credibility of the monetary policy and the central bank. For instance, when we have kind of shock that implies to increase the interest rate when we already announced that we'll be decreasing the interest rate for the next 24 months. So my question is, how do you deal with this process of forward guidance when communicating the monetary policy and keeping the credibility of the central bank in terms of reacting to a macroeconomic environment? Thank you.
We know what the lags are on inflation and the effect of inflation, of the policy rate on inflation. The effect becomes significant at the 1 year horizon. So we do forward guidance. When we do forward guidance, what we have in mind is 1 year, what we will do over the year. Actually, in the discussion on the monetary board, we talk about right now we're easing, when would we cut again, how many times over the year. And that's the reason for that is our model says the lags mean that the effect on inflation takes about a year. So the forward guidance is looking over the next year. I'm not sure what does the Fed do?
Well, I was going to use the organizer's prerogative and just make a follow-up comment to your forward guidance. What you have on the screen looks to me like, I guess maybe another way of putting it is there's a whole spectrum of forward guidance.
Yes.
Right, and even before the Fed started officially started doing forward guidance, it would make comments very much like this, and I like to call that sort of like weak form forward guidance.
Yes.
And at some point it's like, well, sort of weak form is kind of like the same thing as just sort of transparency and communicating why you're doing what you're doing. And then you sort of get stronger and stronger forms to the point like what we used during an unconventional policy period where we'll maintain a zero funds rate until the unemployment rate is X.
Yeah, yeah.
And that's really strong, really
Yes,
forward.
yes,
It has a very
yes.
specific set of conditions. So I think that what you're talking about there, Betuel, is sort of that's much stronger than this if you're saying 24
yes,
months.
yes. This is weaker.
And so this is sort of a very weak form, and probably not much controversy about this kind of very weak form, I would imagine.
Yeah, you remember, Ken, the quantitative easing period. So the Fed had a date-dependent forward guidance. We won't we won't raise the policy rate until whatever. And then they shifted to a data-dependent forward guidance. We won't do something until the unemployment rate goes down to this level. So that's more specific than this. This is deliberately vague.
And not even all that forward-looking, really. It's just more of an explanation about the current policy stance.
Yes,
So in
but
that
the
sense,
market gets it. So as I said, this one meant a shift to a flatter internal yield curve among the banks.
Well, I think we should have a conference at some point on central bank communication and invite Ellie back for that. Other questions and comments from the floor? Fellows, faculty?
Time for dinner.
Another question, Professor? Yeah, seriously? Okay.
Yeah. To be honest, I forgot to ask one question. So, thank you, Professor. I know that Philippines also there are a lot of migrants work abroad, and then there is a debate that remittances also play a role when it comes to talking about the monetary policy transmission mechanism. But in your case, in your country's case, do you care about remittances when you conduct your monetary policy? And does this weaken your monetary policy, or it's strengthened? I don't know. What is your opinion in this issue?
The latest data on remittances is reported during the policy meeting, but it doesn't seem to play much of a role.
Well, that was a short, long question. The ratio of question to answer on that was pretty high. Any other questions or comments before we wrap up? Okay. Right, great. One more over here.
Thank you, Governor. My question is, how does reducing the reserves requirement fit into the broader strategy of anti-inflation, given that it increases liquidity in the market while rates are being raised? So I'm just curious, how does that fit with the broader inflation strategy? Thank you.
It used to be very high, 20% or even higher. At 20%, it was already the highest reserve requirement ratio in the region, higher than Thailand, higher than Malaysia. The U.S. now, so zero, basically zero reserve requirement. It was held so high because we thought, or my predecessors thought, it was a way to control money supply, and the monetary tool was money supply in those days. When we shifted to the policy rate and interest rate tool, it just seemed to drive a wedge between lending rates and deposit rates. And lending rates were what we cared about in this because we still have a bank lending channel that dominates the other channels. So I thought we should reduce it. And we did. Now it's 5%. We might bring it down to zero. The banks tell us it works.
All right. Going, gone. All right.
Thank you.